Okay, exercise 6.3. First thing it asks us to do is it asks us to determine the change in inventories from year to year. And this information was just given to us. We're told that in year 1, the beginning inventory was 180. The ending inventory was 150. So the inventories went down 30,000. 30,000 units, $30,000 units, 30 units. Each unit that was sold, because in this case we sold more than we made, carried some costs from a prior year. Our beginning inventory for year 2 was 150, the ending inventory from year 1. At the end of the year, our ending inventory was 160, so our inventory went up by 10 units. So that means we stored some cost in the form of fixed manufacturing overhead. And in year 3, we have 160 is our beginning inventory, 200 is our ending inventory. So we have 40,000 or 40 more units in ending inventory. So when our inventory goes up, our income seems to go up, okay? But that's because we're capturing prior costs and calling them an asset. Okay, so that we have to explain the impact of that. Well, let's take a look at each year, and our fixed manufacturing overhead in the beginning inventory for year 1 is 81,000, and what that is that's 180 times 450. That's where that number came from. Okay, we got 450 times 180 equals 81. We did the same thing for year 2. And we did the same thing for year 3. So that's the amount of costs that are captured in the beginning inventory. And you can check the number out for yourself. This is 150 times 450. And this is 160 times 450. That's how we came up with the value of fixed manufacturing overhead essentially stored in the inventory. Now we do the same thing with the ending inventory. So we have the 450 times the 150. Okay, we have 450 times 160 and 450 times 200. 450 times 200, 450 times 160, and 450 times 150. That's how we come up with the amount of overhead in the ending inventory. Well, the difference between what we had in the beginning and what we had in the end is the amount of inventory that's either deferred or released. Well, in the first case, because it went down, we released 13,500 of old costs into the sales stream. In the other two cases, we've actually deferred cost. So we have $4,500 of fixed overhead from last year in this ending inventory. And we have $18,000 of deferred costs from last year in this year's ending inventory. Okay, so we looked at the change in inventories and we determined how much fixed overhead was captured in those ending inventories. The last part of the problem asks us to reconcile the absorption costing income with the variable costing income. And it's really pretty straightforward. We have our variable costing income. We're given that. If you look, it tells you, they give us the income for each year, the variable costing inventories for each year, 292.4, 269.2, and 251.8. That information is given to us. That's right out of the textbook. Okay. So they're the variable costing operating income. We want to know the difference. We want to explain the difference caused by absorption costing versus variable costing. We simply add or subtract the additional costs. So in year one, we released $13,500 of costs. So that's going to make the income go down. In the next 2 years, we've deferred those costs. That's going to make the income go up. So we compare the operating income under variable costing, add the amount of fixed overhead that's captured, and that gives us the absorption costing income. And keep in mind, this is the one that you pay taxes on. The IRS likes that one. Now, the last question in this one is they tell us that operating income, the variable costing net income was $240,200, and its absorption income was $267,200. In other words, there was $27,000 more in the absorption costing. So that would tell you that the inventory had to go up. And the inventory had to go up because $27,000 was stored in ending inventory.